Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Aramark, the contract services company that launched an AI data center platform deal and surged 9% to a new 52-week high.
Aramark was founded in 1936 in Philadelphia as a vending machine business. It rebranded to ARA Services in 1959, expanding into food service and catering before going private in a 2001 leveraged buyout.
The company relisted on the NYSE in 2013. John Zillmer returned as CEO in 2019 for his second tenure, restructuring segments and focusing on margin expansion.
In 2026, Aramark launched the Nexus platform, integrated hospitality and facilities for hyperscale AI data centers. The company signed the largest client contract in its history, alongside earnings.
Most recently, revenue was $4.91 billion, beating the $4.75 billion estimate by 3.4% and growing 14.7% year over year. Adjusted EPS of 49 cents beat the 47 estimate.
The company raised full-year adjusted EPS guidance by 20 to 25% and reiterated organic revenue growth at the high end of its 7 to 9% range.
Aramark's moat is long-duration contracts and operational integration. Once embedded across food, facilities, and uniform services at a client site, switching costs are high. Replacement takes years.
The Nexus thesis is structural. Hyperscale AI data centers require large, stable workforces. Aramark provides the integrated services platform that makes those facilities operational.
The long-run engine is contract-based expansion. Each new hyperscaler client adds recurring revenue across food service, facilities, and employee services that compounds over the contract term.
Against Compass Group and Sodexo, Aramark competes on contract flexibility and North American depth. Neither competitor has a comparable AI infrastructure offering. Nexus is differentiated.
AI data centers are creating structural demand for integrated facility services. Remote campuses with thousands of workers need food, facilities, and hospitality at scale on multi-year contracts.
The 20 to 25% EPS guidance raise signals Zillmer's confidence that Nexus and organic momentum are durable, not a one-quarter timing event.
Labor cost inflation is the primary risk. Aramark's business is labor-intensive across food, facilities, and uniforms, making margin expansion sensitive to wage trends.
Zillmer's thesis is that Aramark can re-rate from a food services multiple to an infrastructure multiple by demonstrating that Nexus contracts carry recurring characteristics.
Nexus revenue is not yet in formal guidance. It sits as upside optionality. If the hyperscaler contract ramps on schedule, full-year numbers could exceed the raised guide.
Aramark carries a meaningful debt load from its leveraged buyout restructuring. Free cash flow allocation between debt paydown and contract investment will be a margin management variable.
With the stock at a 52-week high and a new AI infrastructure narrative, Aramark is being repriced. The next test is whether Nexus revenue materializes in the next 2 quarters.
Aramark just posted a 9% gain to a new 52-week high on a revenue beat and the launch of a multi-year AI data center contract.
Let's walk through the Nexus platform and what being an AI infrastructure services company actually means for Aramark's valuation.
Food, facilities, and the AI infrastructure build-out, Aramark is repositioning at the center of a structural demand wave. Now let's get into the numbers. Imagine signing a contract that could be the largest in your 67-year company history, and then telling Wall Street it is not in guidance. That is exactly what Aramark just did, and the stock hit a fresh 52-week high anyway.
Welcome to Charged Alpha. I am Hudson with Lana, and today we are breaking down Aramark's fiscal Q2, a quarter where the headline numbers were strong, but the real story might be something they barely included in the formal outlook.
First, the basics. Aramark, ticker AIR, is headquartered in Philadelphia, Pennsylvania, founded in 1959, and employs roughly 270,000 people across food services, facilities management, and hospitality.
A quick structural note. The old uniform services business was spun off as Vestis Corp in September of 2023, so it no longer sits inside Aramark. What remains is 2 segments, FSS United States and FSS International, pure food, beverage, and facilities services for stadiums, universities, hospitals, prisons, and corporate campuses.
And increasingly, data centers. Wherever there are workers who need to be fed and a facility that needs to run, Aramark is one of the 2 or 3 names that gets the call. That positioning is about to become a very large deal.
Now the numbers, because the quarter itself was genuinely strong. Revenue came in at $4.91 billion, up 14.7% on a total basis and 12% organic, beating the $4.77 billion consensus by nearly 3%.
An honest caveat, roughly 3 percentage points of that organic growth came from a favorable event calendar. An earlier Major League Baseball start and a denser sporting event schedule pulled revenue into Q2, so the underlying organic run rate is closer to 9%, which is still very healthy for a business size.
Adjusted EPS landed at 49 cents against a 47-cent estimate, a 2-cent beat. More importantly, on a constant currency basis, EPS grew 40% year over year, which is the operating leverage you want to see from a services business converting scale into cash.
Adjusted operating income, AOI, hit $258 million, up 24% in constant currency, with margins expanding 50 basis points year over year. That is mix, pricing, and contract maturity all flowing through simultaneously.
The segment breakdown is clean. FSS United States grew 12% organic. FSS International grew 13% organic. Both engines are firing, with International quietly putting up the higher growth rate, a story that does not get enough coverage.
Free cash flow was $305 million in the quarter, up 116% year over year. That is a $164 million improvement in a single quarter. The cash generation that funds buybacks, dividends, and now the capital-light Nexus expansion.
On the operational side, client retention crossed 98%, a company record, and they posted record net new business in education and sports and entertainment. 98% retention across 270,000 employees and thousands of client locations is a moat, full stop.
John Zillmer is the CEO, and the line he keeps repeating is that Aramark has shifted from a turnaround story to a compounding growth story. The Q2 print is the cleanest evidence of that pivot in years. He is also being very deliberate about not putting the Nexus contract into guidance until he has to, which is the right move.
Wall Street is constructive, but the real debate is about Nexus optionality. Announced April 22nd, Aramark Nexus is a purpose-built AI data center hospitality platform. They have already signed a multi-year, capital-light contract with an unnamed top global hyperscaler. Management describes it as potentially the largest contract in Aramark's 67-year history, at several $100 million annualized.
The critical detail: none of that Nexus revenue is in fiscal 2026 guidance. Every dollar that ramps this year is upside. Wall Street is now trying to figure out whether to price it as confirmed business or wait for the first quarterly contribution to actually show up in the numbers.
Even excluding Nexus, the FY 2026 guide was solid. Organic revenue at the high end of 7 to 9%, AOI growth 12 to 17%, adjusted EPS growth 20 to 25%. Those are growth stock compounding metrics from a name that used to trade like a defensive utility.
The stock hit a new 52-week high on the report and settled up approximately 10%. Multiple sell-side desks raised numbers on the AOI margin expansion and the Nexus TAM. The question is whether the multiple re-rates fully before the first Nexus revenue dollar is recognized.
The analyst consensus is buy-tilted, with most desks pointing to the combination of core business momentum, record retention, and the Nexus option as a triple-layered investment thesis. The bear camp is small and focused primarily on the calendar shift issue, questioning whether the underlying organic trend is as strong as the headline 12% implies.
The bull case writes itself. Aramark is the ultimate picks and shovels AI infrastructure play. They do not build the data centers, they do not sell the chips, they feed and support the workers who do, and now they are feeding and supporting the hyperscalers themselves. Capital-light contracts with the world's largest cloud companies, coming from a services business trading at a fraction of software multiples.
Add in the record 98% retention, the record net new business wins, and the FCF doubling, and you have a company that is compounding fundamentals while simultaneously holding the option on a generational contract. That combination, execution plus optionality, is rare at this scale.
The bear case starts with the calendar boost. 3 percentage points of organic revenue growth came from event timing that reverses in fiscal Q3. The optical deceleration in next quarter's print could spook investors who do not dig into the underlying mechanics of the event calendar.
Customer concentration on Nexus is a real risk. One unnamed hyperscaler, however large, is one counterparty. We have seen hyperscaler CapEx plans shift in prior cycles. Microsoft, Amazon, and Google have all paused or redirected large data center programs. If the unnamed partner recalibrates, the Nexus contract recalibrates with it.
And valuation, the stock has rallied meaningfully into and after the print, and the multiple now reflects a portion of the Nexus upside that has not yet hit the income statement. If Nexus revenue ramps slower than implied, the premium multiple compresses before the revenue arrives.
On positioning, options volumes spiked into the print and remained elevated for the following week. Call open interest built at the $52 to $55 strikes for June and July expiration, consistent with institutional positioning for Nexus ramp news and further fundamental beat and raise execution.
Put-call ratio dropped to 0.71 on earnings day, moderately bullish but not euphoric, suggesting the market is treating Nexus as a real but unconfirmed catalyst rather than pricing it as a certainty. That measured optimism is the right setup for a positive surprise to matter.
Insider activity has been quiet over the past quarter. No large opportunistic sales into the run, which is what longer-term holders want to see when a stock is making new highs. Short interest remains low, consistent with a defensive growth name. This rally is fundamental re-rating, not squeeze mechanics.
The forward catalysts are concrete. First, Nexus revenue recognition. Even a partial quarter contribution would force analysts to move from modeling it as optionality to modeling it as earnings. Any additional hyperscaler contract announcements would multiply the TAM conversation.
The Q3 print, stripped of the favorable event calendar from Q2, will be the true test of the underlying organic trajectory. If the X-calendar organic rate holds at 9% or better, the bear thesis loses its anchor. That is the print to watch.
Risks remain on the hyperscaler CapEx cycle, on labor cost inflation across 270,000 employees, and on the broader services sector multiple if macro conditions shift. A single large contract delay or a guidance cut on Nexus timing would be the most damaging single-event outcome.
That is the read on Aramark's fiscal Q2, a clean beat, a raised core setup, and a hidden AI infrastructure story baked in for free. Aramark is no longer just a defensive food services name. It is a compounding services platform with a high-quality AI-adjacent growth option that is not yet in guidance. Subscribe to Charged Alpha for the next update. Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.